Hello everyone. Uh, this is Ejaz Khan. Before I start the session, I would like to introduce myself to all of you. Well, I'm working as director and head of CMA operations in Tabani School of Accountancy. I'm also serving as the president of IMA Pakistan chapter, and recently I've been nominated by Career Testing Services Pakistan Private Limited as one of their members for their board of advisory. Currently, I am a member of 5 professional accountancy bodies: Institute of Management Accountants USA, Institute of Public Accountants Australia, ICWAI, Institute of Financial Accountants, and PIPFA. I have been teaching in Tabani School of Accountancy for the last 9 years, and I've been teaching to ACCA students for the last 11 years. I've taught students of ACCA, CMA, SMA, and my major subjects have been cost and management accounting, financial management, performance management. Well, this is all about me. Now let me introduce the subject of F9. Before we start this session, I would like to discuss the paper format so that you know that what type of paper you will be facing in the exam. Well, the F9 paper will have 3 sections. Section A, which will have 15 multiple choice questions of 2 marks each. Then there will be section B, which will have 3 scenario-based questions split into 5 MCQs each. There will be 15 total MCQs regarding these 3 scenarios. There will be a long question, which will be split into 5 further tasks. Section C, it will have 2 long questions, and these 2 long questions will have descriptive solutions. You will have to write the solutions as you have been doing in the previous formats of the papers. So it will be the same. We'll discuss it later as well. Definitely, it will be a 100-mark paper, and you have to score 50 marks, as is the case with every ACCA paper. About the syllabus, there are 8 syllabus areas. Section A, financial management function; B, financial management environment; C, working capital management; then investment appraisal, sources of business finance, business and asset valuation, risk management, and these one of the areas have been merged into sources of business finance, that is cost of capital. It used to be separately tested in the name of cost of capital. Now it has been merged in the sources of business finance section. If you see the slide, financial management function, this area will only be tested in section A and section B of the paper. It means that you won't be tested with a descriptive long question in this area. So this area is expected to be tested in your section A and B, that is the MCQs area. Financial management environment, again, this area will be tested only in section A and section B of the paper. You won't be tested in the descriptive area of the paper. Working capital management, this area will be tested in all of the three areas. You will be facing MCQs regarding this area. You will be having descriptive long questions in this area. Same goes for investment appraisal, sources of business finance. And then we have business valuation, which will only be tested in section A and section B. Again, you won't be having descriptive question on this area. Risk management, again, you will only be tested in this area in section A and section B of the paper. So there will be no descriptive question from this area as well. So if anyone has any question regarding the syllabus and the paper format, they're free to ask me. Any question? Okay, I think there is no question. On your screen we have the areas that we are supposed to cover in our day one lecture. I will try to stick to the plan, but this plan might change from time to time depending on the time and the number of questions that you people will ask. So what we are supposed to cover in this today's lecture is the introduction to paper F9, basic concepts of compounding, the concept of net present value, the basic concept of internal rate of return, and the basic concept of payback. I will try to stick to the plan. Then we have day two. We'll later discuss it later on. Okay. The first syllabus area that we are going to start is the investment appraisal, which is the very basic of financial management, especially your F9 paper. We'll start from the very basic, and then we'll move on towards the advanced net present value area. Investment appraisal, what is basically investment appraisal? In any business, when you have to manage your organization, you have to take certain decisions. One of the decisions will be the investment decisions. You'll have to invest in projects which will be short-term projects. Let's say they will stay only for a year or less, and there will be long-term projects which will take more than a year, say 3 or 4 years or 5 years or maybe longer than that. Whatever decision, whether it's a short-term or it's a long-term investment decision, the decision will be based on the cost and benefit analysis. You'll have to compare the costs of the decision with the benefits of the decision, and you will only accept any decision when you see more benefits than the cost attached. What we have to study in this investment appraisal area are the techniques through which we will be able to analyze a project, evaluate a project, and to reach a conclusion whether to accept a project or not. The techniques that we are going to study, which will help us to decide whether we should accept a particular project or not, are net present value, internal rate of return, payback period, and accounting rate of return ARR. Before we start any of these three techniques or these four techniques, we'll just first discuss the basics which will lead to these techniques. We'll start from compound interest calculation, which is a very basic calculation of any investment appraisal question, especially when we are calculating net present value. So we are going to start a first area, that is compound interest calculation, and I hope everybody is okay with that. And before I move on to the question, I hope you people are able to see the slides and everything. Look at this example. Mr. A invests a sum of $1,000 for 2 years at a compound interest of 10% per annum. What will be the total value of his investment after 2 years? Let's solve it. See, we are standing at point 0. Remember, in investment appraisal, when we say 0, it means now. It's a starting point. So Mr. A is supposed to invest today a sum of $1,000, sorry, for 2 years. At 10% per annum. Now what we need to find out is what he's going to get after 2 years. After 1 year, he will get 10% of what he has invested. 10% of the 1,000 that he has invested, which is equal to $100. After 1 year, the total value of his investment, including the amount of interest, will be $1,100. In the second year, he will again get 10%, but since it's a compound interest calculation, the 10% will now be of the 1,100 and not the $1,000. So it will be 10% of the 1,100, which is equal to $110. So after the end of second year, he will get $1,210. This $1,210 is the future value of his investment. We can call it sum, denoted by S. And the amount that he initially invested, we can call it present value, or we can denote it with P. So one thing that should be kept in mind is that when we say the future value, it includes the amount of interest. But when we say present value, it excludes the amount of interest. It's the initial amount that is invested or that is expected to be invested. The future value means the amount that invested plus the amount of interest earned during the project life. So later, whenever we will be calculating the future value or the present value, we must know what we are going to calculate. Whenever we are going to add the interest value into the amount, we are actually going to calculate the future value. And whenever we are supposed to calculate the present value, we are actually excluding the amount of interest. The same $1,210 can also be calculated using the formula S is equal to P into 1 plus R raised to the power N, where S is the sum, P is the present value, $1,000 in this case. R is the rate of interest per annum, and N, the number of years or periods for which the amount has been invested. So let's put the values and see if we get the same $1,210 or not. P, which is $1,000, plus R, which is 10%, and we always put it as 0.1. Raised to the power 2, because we need to find out the value of this investment after year 2. And if you solve it, we'll get the same answer, that is $1,210. The reason why we are doing all this stuff is to know the difference between present value and the future value. So you should always keep this in your mind. Later on, whenever we will be calculating present value, we will actually be subtracting the amount of return that is included in the sum. And whenever we are going to calculate the future value, we will actually be including the return in the investment to get the total value of investment. So we can use the same formula, S is equal to P into 1 plus R raised to the power N, for calculating P as well. So let me remove this. So the formula that we've studied is S is equal to P into 1 plus R raised to the power N. Let us rephrase this formula for P. So if you need to calculate P, what we'll do is we'll just divide S by 1 plus R raised to the power N. Or we can also write it P is equal to S into 1 plus R raised to the power minus N. So if we need to calculate the present value with the help of future value, this will be the formula. Let us now solve the same question. Assume that we have been given with the future value, that is $1,210. We have given the rate of interest, that is 10%. And we are told that the project life is 2 years, and calculate P. So we can calculate P with the help of the same formula. S means $1,210, 1 plus R, 0.1, raised to the power minus 2 now this time. So we get back the same $1,000 we have in the question. So what we have actually done is we have subtracted from this sum the 10% interest that we have earned to get the present value of the investment. So this is a very useful calculation and a very basic calculation for the net present value technique of investment appraisal. Now let's see this question. Mr. A is considering to invest a sum of $10,000 in a 1-year project. After the end of the project, he will receive a total of $12,000. If his cost of capital is 10%, what is the net present value of the project? Well, Mr. A, he is supposed to invest $10,000 in a project which is supposed to generate a total of $12,000 after year 1. Now, the decision is whether Mr. A should go for it or not. For this, we need to calculate the net present value of the project. Now, what net present value is, we'll discuss it in a while. First, let us analyze that Mr. A, who is going to invest 10,000 US dollars, and Mr. A wants to generate a return of 10%. That's his cost of capital. We'll discuss what is cost of capital. For the timing, just assume that Mr. A needs to generate at least 10% out of this investment. He is supposed to invest $10,000. For timing, we will just ignore what he is supposed to invest. What is he expected to invest? Let us see what should be invested for $12,000. First, we need to find out what Mr. A should invest against $12,000. Since Mr. A needs to generate 10% return, so what does he need to do is he needs to invest amount X and he needs 10% of this amount as his return, 0.1x. So what we want is we want the principal plus the 10% of the principal to be equal to $12,000. So if he invests X dollars in this investment and he wants 10% of the X, so that the sum of these two should be equal to $12,000. So let us now solve it. 1 plus 0.1, it will be equal to 1.1x and should be equal to $12,000. So all we have to do is to find out that investment which Mr. A needs to invest in this project to get this $12,000. So can you people help me in calculating the value of X? Just put your value in the chat box so that I know. Let's calculate the value of X. Can anybody calculate the value of X for me? Anyone? It's actually $10,909. What does this indicate? This indicates that Mr. A should invest a maximum of $10,909 against the return of $12,000. Even in that case, he will be able to generate 10% of his investment as a return. So he should not invest more than $10,909 in this investment. It is actually, what we have done is we have actually offloaded the amount of interest 10% from the $12,000. We can calculate the same value with the help of the formula that we have just studied, that is P is equal to S into 1 plus R raised to the power n minus n. Just put this $12,000 amount, 1 plus R, we need 10% return, and it's just a 1-year project. If you calculate this, you will get the same value, 10909. So the P actually tells you the maximum that needs to be invested in a project if this, that is 10% return, is required. So it's $10,909. Now, the present value of the $12,000 to ensure 10% return is $10,909. Now, Mr. A should not invest more than $10,909 if he intends to generate a 10% return on this investment. Now, this is what he's supposed to invest. And what he is required to invest in this project is 10,000 US dollars. If he invests $10,909 in this project, he will get exactly 10% return. But he is supposed to invest $10,000, which is less than $10,909. So what do you people think? Should he go for this investment or not? According to his return, 10%, he should invest $10,909 and he will still get 10% return. But the required investment is less than $10,909. So should he go for it or not? I would like to take your answers for that. What do you think? If you people were in place of Mr. A, would you have gone for it or not? So I was having problems getting your answers. Yes, everybody is saying yes, and of course he should go for the investment because the required investment is quite less than what he's supposed to invest. And the amount, the difference between these two values is $909. So if he invests in this project, he will actually save $909. And this $909 is actually called the net present value. Since this net present value is positive, that is, he's going to save from this project, therefore he should go for it. Why do we call it a net present value? You remember, this is the present value. This is the present value of $12,000. We've calculated the present value of $12,000. And $12,000 is the amount that Mr. A is expected to receive, that is the cash inflow. So after 1 year, Mr. A is going to receive $12,000 cash. The present value of that cash inflow is actually 10909. So it is actually the present value of cash inflow. $10,000 is the amount which he's supposed to invest, that is the cash outflow at 0.0, which is actually the present value. So it's the $10,000 is the present value of cash outflow. So if we subtract the present value of cash outflow from the present value of cash inflow, we will actually get the net of these two present values. That's why we call it net present value. And if we see the present value of cash inflows greater than the present value of cash outflow, we will accept the project, since what we are willing to invest, the amount to be invested is lower than that. Therefore, it will benefit us, it will benefit our organization, and we will accept it. Now, anyone having any question? Before we move to our next example, if you have any question, you can ask. Anyone having any question? Did you get the example? Did you understand what the concept of net present value is? Okay, great. So it's a very, very useful investment appraisal technique, uh, and most of the occasions companies do use this technique to evaluate the projects. So let's move towards our next example. Let's take this example now. In the previous example, there was a single cash inflow that we were supposed to receive after 1 year. What about a project in which we will invest at point zero? That is, in this case, Alpha Company is considering to invest $25,000 today in a project which is going to last for 3 years, and it will generate cash inflows after every year till the end of the project. So what if a project gives you return or cash inflows after every year? How will we calculate, or how will we evaluate such project? Alpha Company, let's look at the question. Alpha Company is considering to invest $25,000 in a 3 years project, which will generate following cash flows. After year 1, it is going to generate $9,000 of cash inflow. After year 2, it's going to generate $10,000 of cash inflow. After year 3, it is going to generate $13,000. Excuse me. Now, should Mr. Alpha Company go for this project or not if it intends to generate 10% return every year? How will we solve it? Let us solve it in pieces. Forget about the cash inflows after the year 2 or after the year 3. Just consider the first year cash inflow. And suppose this is a 1 year project. And after 1 year, we are going to receive $9,000 cash. All we have to do, which we did in the previous example, is to calculate the present value of this $9,000. Let us find out what should be invested today against the $9,000 if we need to generate a 10% return. So let us calculate the present value of $9,000. Just take out your calculators and solve it for me. P is equal to S into 1 plus R raised to the power minus N. S 9,000. We need 10% return, that is 0.1. And since we are going to receive this after year 1, so we'll put minus 1 here. And just anyone can solve it for me. Give me the answer. Can anybody calculate it for me? The present value of $9,000. Just write the answer in the chat box. No one? 9763. I don't think 9763. The present value can never be higher than the cash inflow itself. I just need for year 1. Just calculate the present value of year 1 cash flow, that is $9,000. It's 8182. So the present value of the $9,000 is $8182. Excuse me. That is, if we are just going to receive $9,000 after year 1 and we need a 10% return, we will invest a maximum of $8182 against $9,000, which we are supposed to receive after year 1. But this project is a 3-year project and we are also going to receive $10,000 after year 2. So let us now see how much we should invest today against the $10,000 that we are supposed to receive after year 2. How much we are supposed to invest. So let us calculate the present value of $10,000. 10,000 into 1 plus 0.1 raised to the power, since it will be received after year 2, so we'll write -2 here. So let us now calculate the present value of $10,000 which we are supposed to receive after 2 years. It will be 8264. So Alpha Company, if it is going to receive $10,000 only after year 2, it should not invest more than $8,264 if it requires a return of 10%. Similarly, we'll calculate the present value of the $13,000 in the same way. Let's calculate the present value of $13,000. 13,000. 1 plus 0.1 raised to the power -3, since we are going to receive it after year 3. So what will be the present value of $13,000? Let me calculate. It's 9767. 9767. Everybody got the answer? Did everybody get the answer? Do I need to explain it further? Anyone? Any question? Okay, let's now sum all these figures. Against $9,000, Alpha Company should not invest more than $8182. Against the $10,000, it should not invest more than $8264. And against $13,000, it should not invest more than $9,767. So what should be invested for the whole of the project? We should sum all these together. 8182, 8264, and 9767. What should be the sum of these three figures? It will be 26213. So 26,213. And what is this? It is actually the present value of all cash inflows. Is the present value of all cash inflows. This is the amount that Alpha company should, this is the maximum amount that Alpha company should invest against these three cash flows, 9,000, 10,000 and 13,000. The Alpha company is required to invest $25,000 in this project. So the maximum it should be willing to invest is $26,213 if it needs a return of 10%, and the required investment is $25,000, which is less than what it can invest. So what's the difference? It's $1,213. This is the present value of cash inflows. This is the present value of investment, cash outflow. And this is the net present value. Since the required investment is less than what Alpha company should invest, therefore Alpha company will go for this investment. It will add $1,213 to its value of company. Any question from your side? Anyone? Try to be interactive so that I know that you people are getting it and I should move on. So did you get this example? Is it clear now? Okay, let's move towards another example. Just quickly solve this question for me and give me the answer for this. You have 2 minutes, just calculate it for me, and then I will explain it to you. It's exactly the same situation as the last example, except for that we are getting equal amount of cash inflows every year. But this will not affect your calculation. So go ahead and calculate the net present value of this question. The same discount rate will apply, then that is 10%. So calculate the present values of these cash inflows for me. Yes, Faiza, your answers are correct for year 1 and year 2. Yes, for year 3, exactly the same. It's 90918264 and 7513. So these are the maximum amounts that Seco company should invest against these $10,000 to be received in year 1, 2, and 3. So can I have the total of these 3 cash inflows? Excuse me. Can I have the total of these 3 cash flows? Can anyone calculate the total of these 3 cash flows for me? It's 24868. The sum of all these 3 cash inflows is $24868. That is, Seco company should invest a maximum of $24,868 for this project. So it's again present value of all cash inflows. Now let's see how much investment is required. That is present value of cash outflow. The required investment is $20,000. The maximum Seco company should invest is 24868, which is $4,868 high. So the net present value again is positive. Therefore, Seco company should go for this project. I hope everybody has got this. This is exactly the same question as we did in the previous example. Okay, I'm just going back to the previous example. Going to the previous example. And now I want everyone to listen very carefully what I'm going to explain this time. It's very important. It's actually the shortest way of calculating the same values. So do listen carefully. Let me first erase all these. Okay. Well, when we were calculating the present value of $9,000, we wrote $9,000. Then 1 plus R, that is 10%, 0.1. And since we were going to receive it after year 1, so we wrote -1 as a part. And we got answer 8188 What is what does this 8182 mean? It means that the maximum investment today against $9,000 of year one should be $8182. This is $8182 is the present value of $9,000. What if I ask you to calculate the present value of $1 which we are going to receive after year one? So instead of writing $9,000, I will just write 1 because we are now going to calculate the present value of $1. So instead of calculating the present value of $9,000, we are now going to calculate the present value of $1 which we are going to receive after year one. So $1, same 1 plus 0.1 raised to the power minus 1. Now, I'm not going to calculate the present value of $9,000 this time. I'm going to calculate the present value of just $1, which we are supposed to receive after year one. Can anybody calculate the present value of this $1 for me? I, just give me a minute. Actually, I can't see your questions or answer your replies in the chat box. We'll just fix it in a minute. Just wait for us.
स्क्रीन पे शेयर करें आपकी स्क्रीन शेयर।
Okay, sorry for the disturbance. Actually, I was not getting your messages. Now I'm getting your messages. Uh, can you calculate the present value of this $1 for me? Anyone can calculate? Can anyone calculate the present value of $1 for me? Can you people hear me? All you have to do is to write yes in the chat box. It won't cost you much. Not, I don't know whether you people are getting me or not. Am I audible and visible to you all? Okay, that's great. So, can you calculate the present value for me? I don't know if you have already calculated because I can't see your message properly. Let me just see if I can fix it. Oh, present value of $1. It's point. It's $0.909. It's $0.909. Now, what does this mean? If we are supposed to receive $1 after year one, the maximum that we will be investing against this $1 will be $0.909 if we require a 10% return. Now, why we have calculated this figure? This is the present value of $1. If we need 10% return and we receive $1 after 1 year, the maximum today that we should be investing will be $0.909. Now, if I tell you, or I give you this figure, that the present value of $1 after year one will be $0.909 and ask you to calculate the value of $9,000, all you have to do is to multiply it with this 0.909 and you'll get approximately the same answer, 8182. Because I've given you the $1 present value and I have asked you to calculate the present value of $9,000, all you have to do is to multiply it with $9,000. This $0.909 is called discount factor. That is, the present value of $1 will be called discount factor. So the present value of $1 after year one at 10% rate of interest will be $0.909. Okay, can anyone calculate the present value of $1 after 2 years at 10% rate of interest? After 2 years. Can anyone calculate the present value of $1? that is going to be received after year 2 at 10%? Anyone can calculate? I'm just waiting for your answer. Can anyone calculate the present value of $1 to be received after 2 years? Bilal, do you need to ask anything? Just got your message. Can you ask a question? Bilal, Farooq, can you hear me? Okay, I'm sorry. Now I'm getting your questions right now. So I'm sorry, I wasn't getting your messages earlier, and now I'm getting all the messages, and I'm really sorry for that. So it's 0.826. So the discount factor for year 2 will be 0.826. Now, if you multiply 10,000 with 0.826, you'll get the same answer, 826 approximately. And the same way, if we calculate the discount factor for third year, it will be 0.751. So these discount factors are actually the present values of $1 after different years. So the importance of these discount factors is that if we know the discount factor, all we have to do is to multiply with the cash inflow to get the present value. So if you know that the discount factor for year 1 at 10% is 0.909, you can simply multiply this discount factor with the cash inflow to get the present value. So you need not to do it through the formula, which will take your time. So you just need to multiply the right discount factor with the cash inflow to get the present value. Let me remove everything from the slide. So the discount factor for year 1 is 0.909 at 10%. It's 0.826 for year 2 and 0.751 for year 3. And remember, this is for 10% rate. So the question is that, will you be given the discount factors in the exam question, in the exam? Yes. Your question paper will have the discount factor table, which is called the present value table, and it will look like this. It will look like this. It will have columns. Column wise, you will be given the rates, and the row wise, you will be given the number of years. So in our example, the rate was 10%, and we had 3-year project. And if you see, the discount factors are here, which we calculated using the formula. They are here: 0.909, 0.826, 0.751. So we have got these 3 discount factors from the table. We need not to calculate these discount factors. We just need to pick the discount factors from the present value table and multiply with the relevant cash inflows to get the present value. So it will make our calculation much easier. I hope everybody has got this. So if anyone has any question, ask me. That's before we move towards our next question. Anyone? Any question? Any question? Can anyone ask any questions so that I'm sure that I'm getting your messages? Bilal, you had problem with the questions. Can you ask me a question if you're there? Anyone? I'm not sure whether I'm getting your question, your messages or not. Can anyone send a message so that I'm sure that you people are getting my messages? Waiting for any question. Just write hello. If you don't have anything to ask, just write hello, so that I'm sure that I'm getting your messages right. Okay, thank you. Thank you, Faisal. I got your message. Okay.
Mute.
I'll just give you a question. You people are going to solve that question for me. Just wait a minute. I'll give you a question, and you people have to solve this question using discount factors. So just wait. So okay, this is the question. You have a discount rate of 10%. The initial investment is $30,000, and from year 1 to 3, you're going to receive $12,000, $15,000, and $10,000. Can you people solve this question for me with the help of discount factors? All you have to do is you have the PowerPoint slides with you. Just go to the present value table, pick the discount factors for 10%, and just calculate the present value for me using discount factors. Do not use the formula, just use the discount factors. In the exam, you have to use the discount factors rather than the formula approach. So go get the discount factors and solve this question for me. Meanwhile, if anyone has questions, you can ask. Yes, Wahab, you need to ask something? So now I'm getting your questions. You may ask any question. Rishad, I can see your question. I can see your comment. Waqas, the future cash flow of 9,000 when we take in present value, it shows 8182, which is without interest, right? Yes, Waqas, you're right. Sikandar, it would be great if you repeat your question. Renuka, I'm not sure whether the answer is right or not. We will be solving it in a while. Wahab, you can ask now questions. I'm getting your questions. Kulan, I'm on the question slide. The question is right in front of you. Can't you see the question? Yes, I'm getting the answers. So keep the answers with you. I will be solving it, and then we'll match the answer. And if you did not understand anything, we'll explain. Okay, majority of you are getting 808 as your net present value. Let us solve this question now. We'll see. Nasser, we will see the question. Let's see. Remember, at point 0, the discount factor is always equal to 1. At 10%, year 1, the discount factor will be 0.909. We've seen the table. At 2, it will be 0.826. And at 3, it will be 0.751. So we have the present values of $1. And all we have to do is to multiply every cash inflow with its relevant discount factors. So let us calculate it one by one. We have to multiply 12,000 with 0.909. So it's 10908. 15,000 into 0.826. 12390, and then we have 7510. So let's just sum all these present values to get the total present value of the cash inflow. 10908 plus 7510. So it's 30808, and the present value of cash outflow is 30,000. So if we subtract 30,000 from 30808, we get 808 positive. So the net present value is 808. Since it's positive, we should go for it. So everyone with the answer of 808 NPV, that's correct. So I would try my level best to answer all the questions, but definitely we have a time constraint. So few questions might be missed, but I will try my level best to answer every question. But my request to all of you is, do not ask questions randomly. I will ask for the questions, and once I ask for the question, then you may ask the question. Because if you ask during my lecture, I will miss them, because my concentration will be on the question and not on the questions. So I will give you time to ask questions. I will not move forward before I've answered all your questions. So rest assured, I will answer every question which is relevant, and we'll give you time for the questions. So now, if you have any query regarding this question, you may ask, and otherwise we'll proceed. Anyone having any question? So the answer is 808. Okay, let's go back to that example. Let's, okay, Arslan, Arslan, we will discuss the exam techniques later on when I'll be discussing the mock, and on the last day we'll be discussing the exam techniques as well. But the techniques that you will be required in different topics, I will be telling whenever I'll be teaching that topic. The techniques required for attempting a question regarding that topic will be taught during the topic, and about the general techniques, exam techniques, we will discuss it in our on our last day. Sidra, yes, you can use calculator for calculating discount factors, but it is not recommended to do so, because if you use the discount factors from the table, your answer will be very much close to the examiner's solution, and it will avoid deviations from the standard answer. So you can use calculator, but it's advisable not to do so. It will take more of your time, and also it will there will be so much of the problems with the rounding off. So it's better to use the table rather than the calculator for calculating discount factors. So let's move. Okay, if you look at this example, each year we are receiving the same cash inflows, and in any project, if we are receiving same cash flows every year, the cash flows will be called annuity. This is called annuity. $10,000 every year. So it's actually annuity, where you're going to receive same amount every year. So in this project, we are going to receive 10,000 every year. So it means it's an annuity project. And we have solved this question using discount factors 0.909, 0.826, and 0.751. And then we got the present value of 24868. If we sum these three discount factors, if we sum all the discount factors, 0.909 plus 0.826 plus 0.751, we'll get the cumulative discount factor, and we can also call it annuity factor. So can anyone sum all these discount factors for me and give me the answer? What's the answer of this? $2.487 or 2.486 approximately. Yes, you're right. Everyone is right. So write the answer. 2.486 approximately, 2.487 and 2.486. Yes, it's the correct answer. So this is called annuity factor. The sum of all the discount factors will be called annuity factor. This is annuity factor for a 3-year project. Okay. Now, if I take this annuity figure, 10,000, and multiply it with the annuity factor 2.486, I will get 24860 present value, which is approximately equal to this value, 24868. So there is an $8 difference, which is a rounding off error. So 24860 and 24868. So if we sum all the discount factors to get the annuity factor and then multiply this annuity factor with the annuity, we will get the total present value of cash inflow. Excuse me. But remember, we can't do this for a project which has different cash flows in every year. So remember this, we can only multiply annuity factor in case we have annuity. So we'll multiply the sum of the discount factors, that is annuity factor, with the annuity, and we'll get the present value. Now, do we have any table showing annuity factor? Yes. In the exam, you will be given with a table. On one side, you will be having the present value of $1. That is the individual discount factors, 0.909, 0.826, 0.751. And on the other side, you will get some of the discount factor, that is the table for annuity factors. Let me show you how does it look like. So this is how annuity factor will look like. If you see this table, it's similar to the discount factor table. It will have discount rates at the top, and it will have number of years. All we have to go to the right discount rate, 10%. And since we were looking for a 3-year project, so we'll look at the row 3, 2.487 or 2.486. It's a rounding off difference. So 2.487 is the annuity factor for a 3-year project that starts from year 1. So you'll be given these figures in the exam. All you have to do is to pick the right annuity factor from the table and multiply it with the annuity, and you'll get the present value of all cash flows, irrespective of the number of years. Even if it's a 10-year project, you have to pick the 10th year annuity factor, which is not here in this, but you'll be given in the exam. It's a partial annuity factor table. So a complete annuity factor will go to, I guess, to 20 years or 15 years. So you will be given in the exam. You have to pick the right annuity factor and multiply it with the annuities to get the total present value. So let me give you a question. Forget about this question. I'm writing the question here. Just note down this question: 0, 1, 2, 3. Suppose you are going to invest $20,000 in this project, and every year you're going to receive $12,000 for 3 years. Your discount factor should be of 8%. So calculate net present value. Do not use discount factors, use the annuity factor and calculate the net present value for me. Remember, the rate of discount is 8% and the project life is 3 years. So pick the right annuity factor from the table and calculate the net present value. Quick. Remember, all you have to use the annuity factor. Do not use discount factors. Let us practice the annuity factor first. Okay, I'm getting your answers and we'll be solving in a while. Okay, this is the annuity table. The discount rate for us is 8%, so move to this column. And the project life is 3 years, so the annuity factor relevant for the question will be 2.577. So we'll use this annuity factor for the question because our discount rate is 8% and the project life is 3 years. So let's all we have to do is to pick the annuity, that is $12,000, multiply it with the annuity factor that we just picked, which is 2.577. So 2.577. So if you multiply 12,000 with 2.577, we'll get 30924. 924. And the investment is $20,000, so we'll subtract $20,000 from the present value and we will get 10924 net present value. So Sidra, and your answer is 30924. It's not the net present value, it's the present value of cash inflows, right? So we have to subtract 20,000 to get the net present value. So 10924 is approximately the net present value of this project. I hope everybody is done with it. Yes, Azim, your answer is absolutely correct. 10924. Hold on, we will explain. We will discuss lease or buy later on. It's not our topic of today, but we'll definitely discuss it. So let's move forward. Okay. Now, in all our examples, the cash inflows were starting from year one. And we have an example in which first cash inflow will be received at point zero. Now let us learn how to calculate the present value of an annuity that starts from zero, that is today. Look at this example. Mr. A is considering to invest in a project which will generate $10,000 cash flow per annum. First one due now, that is the first $10,000 will be received at point zero. The project is a 3 years project. If the cost of capital is 10% and initial investment is $18,000, the net present value of the project is. So we need to calculate the net present value of the project. Let us calculate it in a tabular form first, and then I will teach you the shortcut of calculating the same with the help of annuity factor. So the first cash flow we are going to receive at point zero. So write it $10,000 here, and we all know that the discount factor for year zero will always be equal to 1. Then the next cash flow we are going to receive after year one, that is $10,000, and the third cash flow will be received at end of year 2, which is the start of year 3. So since it's a 3-year project, and in a 3-year project we'll always get 3 cash inflows with these timings, 0, 1, 2. It's just because of it's starting from year 0. So 10% cost of capital. So we'll go to the discount factor table and we'll go to the 10% column and we'll see what are the discount factors. So for year 1, the discount factor on the discount factor table will be 0.909 and 0.8264. And all we have to do is to multiply these figures. So we'll get $10,000. We'll get 9090 approximately, and then we'll got 8260. So if we sum all these three together, $10,000 plus 9090 plus 8260. So the total present value of these three cash flows will be 27350. So this is the present value of cash inflows. The required investment will be $18,000, and the present value of cash inflows, which is 27350, exceeds the 18,000 by $9,350. So $9,350 is the answer, net present value. So this is the tabular approach of solving this question. So all we have to do is we have placed the cash flow in the at the right years, and we have picked the discount factors from the table and multiplied with the cash inflows to get the present values. We have summed all the present values and we have deducted the investment from it, and we got net present value. Now 27350, how we can calculate it using annuity factor. This is the formula of present value of advanced annuity. All we have to do is write the annuity here, 10,000. Take the annuity factor for the project life, that is, we have a 3-year project life, so go to the annuity factor table. Go to the annuity factor table, the discount rate is 10%. We have to pick the annuity factor for 3rd year, that's 2.487. 2.487. Just write it 2.487, and then multiply it with 1 plus R. 1 plus R. R is the rate of cost of capital, that is 10%, 0.1. So multiply the annuity with the annuity factor and then multiply it with 1 plus R. So you will get approximately the same answer, 27350. Just do it for me. Can you just calculate whether we are getting the same answer or not? Yes, approximately the same. 27357, which is approximately the same one. And then later on we have to deduct the initial investment of 18,000 to get the net present value. So let's deduct 18,000 from this figure. And we'll get net present value 9350, approximately 57. Yes, by and large, everyone is getting the right answer. So this is the solution to advanced net present value. So I hope everybody has got it. So let us move forward. Now, look at this example. This is now delayed annuity. Remember, if any annuity that starts from year 1 is a normal annuity, advanced annuity that starts from 0, annuity that starts from year 1 is normal annuity, and if any annuity or project that starts generating cash inflows from year 2 or onwards, it will be considered as delayed annuity. Now, how to solve a problem with a delayed annuity? Aisha, you were right. Mr. A is considering to look at this example of delayed annuity. Mr. A is considering to invest in a project that will generate $10,000 cash flows per annum. More importantly, it starts from year 2. So it's not a normal annuity. It's an annuity that is starting from year 2. And remember, the normal annuity starts from year 1. So it's starting from year 2. The project life is 4 years and the cost of capital is 10%. If initial investment is $18,000, the NPV of the project is what we have to calculate the net present value in this case. So how do we do it? Again, first we'll solve it through the tabular approach, which is the universal approach. You can use it anytime, but definitely it will take time. So we'll go to the formula approach as well. So let's put in the values. The first cash inflow will be received at year 2. So I haven't written 0 and 1 because it is starting from year 2. So we are starting from year 2. So the first $10,000 will be received after the end of year 2. The second cash inflow will be received after the end of year 3. And the last cash flow, since the project is of 4 years, so it will not exceed that. So the last cash inflow will be received at the end of year 4. So first one at the end of year 2, second one at the end of year 3, and third one at the end of year 4. These are the discount factors for the relevant years. I've already put it on the table so that it does not waste our time. Okay, just help me in calculating the present value. So just multiply the values with the discount factors. I guess I can do it. 8260, 7510, and 6830. So let's sum all these together. 8260 plus 7510 plus 6830. So it's 22,600. The initial investment, $18,000, and the net present value will be $4,600. Excuse me. So this is the answer. But we have a formula approach to it. Whenever we have a delayed annuity, we have a formula for that. Let's just use that formula now. All we have to do is to pick the annuity from the question, 10,000. Then we need to pick annuity factor. Now, annuity factor, which annuity factor should we be using? Remember, we have to count the number of cash flows that we're going to receive. It's a 4-year project, and usually it starts from year 1. So if it was a normal annuity project, there would have been 4 cash inflows after year 1, after year 2, after year 3, and after year 4. Since it's starting from year 2, it means that we are not going to receive anything after year 1. So what we are going to receive is the 3 cash flows, year 2, 3, and 4. We will be receiving cash inflows after year 2, after year 3, and after year 4. So the total cash inflows will be 3. Remember this, we need to count the cash flows. So there will be 3 cash inflows in total. So all we have to do is to pick, the cost of capital is 10%, and we have to pick the annuity factor for 3 years and not 4 years. Remember this, we will not take the annuity factor of the project life. We will count the number of cash flows and we'll pick annuity factor for the number of cash flows and not for the number of years of the project. Since there are 3 cash inflows, we'll go to the annuity table, we'll go to the 10% column, and for 3 cash flows, the discount factor will be 2.487. Don't take this 4-year annuity factor. You just need to count the number of cash flows. So there are 3 cash flows, we'll take the 3rd-year annuity factor. So take the 2.487. So 10,000 will be multiplied with the 2.487. Then it will be multiplied with discount factor. Now, to get the right discount factor, all we have to do is to count the delay in years. The normal annuity starts from year 1, and this one is starting from year 2. So there is a 1-year delay in the starting of annuity. Usually it starts from year 1 and it's starting from year 2. So there is a 1-year difference between the normal annuity and the delayed annuity in this case. So what we have to do is to go back to the discount factor table to the 10% column, and since there is a 1-year delay, so we'll pick 0.909 as our discount factor for this question. So go back to the question and multiply it with 0.909. So let's multiply 10,000 into 2.487 multiplied by 0.909. So we'll get the same, approximately the same answer, 22,607 dollars, which is approximately the same that we calculated here, 22,600, and it's 22,607. And then we will subtract 18,000 from this to get the net present value, which is equal to 4,607. Approximately the same what we calculated using the tabular approach. So let me repeat this once. Annuity factor, you have to multiply annuity with annuity factor and discount factor at the same time. To get the right or relevant annuity factor, you need to calculate the number of cash flows. In this project, we have 3 cash flows. So we just went to the annuity table, we went to the 10% column and year 3 row to get the relevant annuity factor, because we will be receiving 3 cash inflows. And when we'll be picking the discount factor, we need to calculate the delay in years. The normal annuity starts from year 1, and in this case, the annuity is starting from year 2. So there's a 1-year delay. So we'll go to the discount factor table and we'll pick year 1 discount factor. So we'll multiply these 3 figures, we'll get the present value of cash inflows, and then we'll deduct the initial investment to get the net present value. I hope everybody has got this. Any question? Do you people have any question? Thank you very much.
Dania, we will be discussing perpetuity later on. At the moment, we're not discussing perpetuity. It is there. We'll be discussing it. Sikandar, what's your question? I didn't get your question. I'm just getting your question mark. So ask a question. Waji, we haven't ignored initial investment. We have subtracted initial investment at the end. So Rishaba, I didn't get your question, right? If Muhammad Talha, if we have a 4-year project and we are starting it from year 1, we will get 4 cash flows. But if it's a 4-year project and we are going to get the first cash flow after year 2, then we'll only get 3 cash flows because we're not going to get anything in year 1. Sidra, your question is that actually people are. It would be great if you people ask questions one by one because you're asking so many questions and I'm not able to read them properly. So just hold your horses, everyone. Let me answer the question of Sidra, and then we'll go on and try to answer all of you. Sidra, your question is: if we have 2 years delay and cash flows start from year 3, then what? If we have 2 years delay, we'll take the discount factor of year 2. And if it starts from year 3, your question is not complete. Actually, you have to tell me the project life as well, because without project life, we can't pick the right annuity factor, because how many number of cash flows we are going to get, it depends on the project life. So for example, if we have a 10 years project, usually we will get 10 cash flows. But if we are starting it from year 3, it means that we're not going to get anything at the first year end and at the second year. So of the 10, we're not going to get 2 cash flows. So we'll be left with only 8 cash flows. So the project life should be there in order to calculate the number of cash flows. Hassan, keep it simple. Remember, the normal annuity project starts from year 1. Now, in an exam question, all you have to see is to see when the cash flows are going to start. If the question says that it will start from year 4, we know that it normally starts from year 1, and if it starts from year 4, it means that there will be a 3-year delay. So all we have to do is to pick the 3rd year discount factor. Remember, the benchmark year is year 1. And all you have to do is see from which year in the question the cash flow is going to start. Sikandar, your question, how to identify we have 3 cash flows. You just look at the question, look at the project life. What's the project life? Say, for example, the project life is 10. And then just count in which years we are not going to get anything. Just subtract that figure from 10. For example, the cash flows are starting from year 3. So it means that we are not going to get anything after year 1. We're not going to get anything after year 2. So of the 10 years, we will not receive anything till 2nd year. So we will not receive 2 cash flows out of 10. So we'll receive only 8 cash flows. I hope this has answered your question. Okay, let me give you another question. Solve this question for me, and hope that will answer all of your questions. Just solve this question for me. we have solved this question for me. It's a 6-year project. Cash inflows 8,000 per annum, starting from year 3. Discount rate at 10%. Just calculate the present value. Forget about the net present value. I haven't given initial investment because all we have to do is to subtract the initial investment at the end. So it's not that much complicated. So just calculate present value for me. We'll be solving this question. I'll be solving this question in a while. Just try yourself and we'll discuss it. Remember counting cash flows and counting the delay in years. Okay, let me solve it for you people. This is a 6-year project. Okay, this is a 6-year project and it is starting from year 3. That means we will not receive anything at the end of year 1. We are not going to receive anything at the end of year 2. So out of 6 years, we will not receive anything for 2 years. So we'll be left with only 4 years. So there will be 4 cash flows in total. I hope it's clear. So we have 4 cash flows in total. So the annuity is 8,000. Cost of capital is 10%. So we'll go back to the annuity table. 10%. And since we are going to receive 4 cash flows, so we'll go to get the 4th year annuity factor, that is 3.170. So we'll go 3.170. So this is the annuity factor. And then we'll be picking up the right discount factor. Remember, this project is starting, this project will start generating cash flows from year 3. So normally it starts from year 1 and here it's starting from year 3. So the difference between 3 and 1 is 2. So there's a 2 years delay in the cash inflows. So we'll take the discount factor of year 2. Remember, we're not going to take annuity factor again. We're just going to take the discount factor. So discount factor for year 2 at 10% will be 0.86. So this is our discount factor for the question. So multiply it with 0.826. What's the answer? 8,000 into 3.17 multiplied by 0.826. So it's 20947. So this is the present value, this is the right answer.
स्क्रीन बंद करके ऑन करिए.
I hope you people are getting the screen right. So 8,000. The annuity factor is 3.170 because we have total 4 cash inflows. Of the 6 years project, we're not going to get anything in year 1 and 2, so 4 years cash flows, and there's a delay of 2 years, and we have picked the second year discount factor. So this is the answer. I hope you people have got the question, right? I think we should take a 10 minutes break, and yes, Taha, you can ask the question, and we have a 10 minutes break. You people may go for a break, and meanwhile, if anybody has any question, I'm here to answer the questions. So. Sikandar, yes, the cost of capital can be in points, but usually you won't see this in points because the discount factor table and the annuity factor table, they are in whole numbers. So I'm not expecting the examiner to be giving you the cost of capital in decimals, but yes, it can be, but usually it won't be. Bilal, why did we skip year 3 in last example? Can you just elaborate your question? I didn't get what do you mean by skipping year 3? Kulan, we will discuss the past papers, don't worry. We will solve MCQs for the past paper as well, so it will answer your question later. Shiraz, sir, are you getting my answer? I'm not sure if it's there. Can you repeat your answer so I'll see it? Because I'm getting too many messages, so maybe I've skipped it. Taha, we'll discuss the impact of inflation in investment appraisal later. We are keeping it simple for now, and we'll move on to incorporate inflation as well. But for the time being, remember one thing, the cost of capital does include the impact of inflation. Initial investment should not be counted while calculating the cash inflows because we are not calculating the total cash flows, we are calculating only the cash inflows. We'll just count the cash inflows. Remember, when calculating cash inflows, we'll ignore the initial investment because it's a cash outflow, not cash inflow. Yes, Shiraz, I'm getting messages of everyone. But since there are so many messages coming in, so maybe there's a chance that I skip 1 or 2. So I'm getting your messages. Shahruz, your question, 6 years count is from start of the period or from third year? From third year. To count the cash flows, you have to start from year 3, 3, 4, 5, 6. So we will start like this. We won't start it from 0 because the cash flows are starting from year 3. Sikandar, I haven't got your question. Can you please explain it further? Dania, there are multiple ways of solving this question. Because of time constraint, I have restricted myself to only one way of calculating it, and to avoid any confusion, that's why I haven't solve it using any other way. But if you can get the same answer in any other using any other approach, you're free to do it. There's no one way of solving it. So there are multiple ways of solving the present value. Usman, it shows that you have left, but yes, you can use this approach as well. I've told you that I have only restricted myself to one approach because of the time constraint and avoid any confusions. So I just restricted myself to one approach. You can use any other approach if it gives you the right answer. Dania, no, we can't discount it using 6 years annuity factor because we are not receiving 6 cash flows. So we can't use 6-year annuity factor in this question. Simple. So we can't use this. Because if you use 6 years annuity factor, you are actually assuming that you have received 6 cash flows. The cash flows are not 6, there are 4 cash flows, and those cash flows will be received. So we will start receiving those cash flows after year 3. So we can't use 6 years annuity factor. Arbab, yes, the answer is very much close to it, and there is no harm in using the tabular approach, but it will take more time, therefore it's better to use the formula approach. But make sure you use any approach when you have full command of. Yes, Bilal, in the slides we have day-wise plan. Definitely it's a theoretical plan. We'll try to stick to this plan as much as possible, but definitely if you'll come up with more questions, that will take more time, so the plan will change to some extent, but by and large the plan will be the same. Sikandar, well, your question is not a straightforward one, and the answer will not be a straightforward one, but my recommendation to every student during the preparation of the exams, especially when exams are very close, do more practice. Concentrate on practicing more than learning more, because you have less time and you have to practice as many questions as you can. Taha, I will try my level best to deliver everything that you need to pass the exam, but at the end of the day, it depends on you how you capitalize on it. So I will try to teach at least something that will help you pass the exam, but it depends on you how much practice you do at home. Do practice a lot. Whatever I teach you in this webinar, go to home, practice it, solve the questions as much as you can, and it will be of great help to you to pass the exam. Mohammed Abrar, you're saying that the project life is 6 years and you're still receiving cash inflows after 8 years. How can you say that then it's an 8-year project? If you're going to receive your last cash flow in 8th year, it means that the project is going for 8 years. Nasir, I didn't get your question. just Dania, on the screen there is a formula for advanced annuity. So in this, I guess the key to success is going through the whole syllabus. You need to have a command over the whole syllabus, and I can't really tell you which area to focus only on. Go through the syllabus, but I would suggest to go for the past papers. Go and solve all the past papers, and or if not all, if not possible, then at least as much as you can. And past papers will be the best guide for the exam preparation. Sikandar, again, I would say go for the past exam questions and solve as many as you can. Dania, can't you see on the screen the formula for advanced annuity? Well, I will be recommending questions from the past exam, from the past papers. Every day I will give you questions to solve at home, so don't worry about that. Tomorrow we'll be moving towards our advanced NPV questions, the long question that you might face in the exam. We'll be solving net present value advanced questions, long questions. Dania, yes, we'll be discussing sensitivity analysis as well. Sana, it's not possible to discuss the whole thing again, and at the end of the session, I will give you my YouTube channel link. I will give you my Facebook link. You people may ask me anything after the session as well. So if anybody has any problems in any area, he or she can discuss with me later on as well. Due to time constraint, it's not possible to repeat everything here. Waqas, yes, you are right. The company will usually accept projects that have positive net present values, so that it increases the value of the company. So. Taha, yes, definitely we'll be discussing theoretical part as well. At the moment, we're just discussing the basic calculation. That's why there is less of the theory section, but definitely we'll be discussing the theoretical part as well. Qasim, we may discuss it later on after the webinar, or I'll share my contact details with all of you. And if you people have any problems or any other thing that you want to discuss with me, you will be free to discuss with me later on. It's not possible to repeat all the stuff in this webinar again. Sakhi will be discussing inflation in tomorrow's lecture, so don't worry, that will be discussed. Dania will be discussing theoretical part, don't worry about that. There must be a calculation mistake. just recalculate the figure, and I don't think the difference should be that much. Okay, let's move forward. Yes, the 10 minutes are over. Thank you, Taha. So let's move. Now hold your horses. The question answer session is over for the time being. We'll move towards our next area. Now let's discuss another concept, that is perpetuity, an annuity that lasts forever. Suppose that we buy a share of a company, and against that share we'll be receiving dividends. But when we buy a share of a company, we are not entitled to a definite period of dividends. We will be receiving dividends till we hold the share or till the company is there. So we'll be receiving dividends for an indefinite period of time. And if we are investing in anything like this, which will give us returns forever or for indefinite period of time, that annuity will be called as perpetuity. Let's look at this example. What will be the present value of $6,000 received per annum starting in 1 year's time? Remember, whatever starts in 1 year's time is something normal. In perpetuity means you will receive it for indefinite period of time. If cost of capital is 10%, what should be the present value? So what we have to do is to calculate the present value of $6,000. It's very simple. Just take the annuity, that is $6,000, and divide it with the cost of capital or discount rate, that is 0.1. So you'll get the present value, that is $60,000. So the present value of the cash inflows that you will receive forever will be $60,000. What does that mean? It means if company needs 10% return, at least 10% return, then it should invest $60,000 today against the $6,000 that it is going to receive after every year till perpetuity. And it's very simple to understand why we are saying that it should invest $60,000. If company invests $60,000 and it needs 10% return, that is 10% of 60,000 is equal to $6,000. So it will need $6,000 every year to justify this investment. And since this project is giving $6,000, which is 10%, therefore it should invest a maximum of $60,000. If it invests more than $60,000 and still receive $6,000, it means it will receive less than 10%, which will not justify the investment. So to justify the investment, the maximum amount should be $60,000. So if you have any project that gives you returns for indefinite period of time, this is how we calculate the present value. So it's very simple. Just divide annuity with the discount rate. Okay. Okay, just calculate net present value for this question. Cash inflows $9,000 per annum. Project life perpetuity rate 10%. Investment $82,000. Calculate net present value. Taha, no, 0.1 is not referring to year 0. 0.1 is the cost of capital. It means that if you want a 10% return, how much should we invest for 6,000 per annum? That's 60,000. Yes, the answer is 8,000, correct. Simple. We are going to receive 9,000 per annum. The discount rate is 10%. So against 9,000 per annum, if we need a 10% return, how much should we invest? We should invest 90,000, whose 10% is actually equal to 9,000. But we are required to invest just $82,000. So we will save $8,000. That's the net present value. I hope everyone has got it. Should we move forward? Okay. Now on your screen there is a question. Just ignore the question for the time being. Just concentrate on this example. Suppose a project had an NPV of $6,000 at 10% rate. I'm going to ask you a question, okay? So listen to the question carefully. So suppose that the project has positive NPV of 6,000 at 10% cost of capital. Should we accept this project or not? Quick, yes or no? Quickly, everyone. Should we accept this project? Yes. And the reason is that at 10% we are saving, so it means that we are earning more than 10%. Okay, I've got an answer. Now, let's suppose the same project has a negative NPV of $8,000 at 15% discount rate. Should we accept or reject? We should reject it, definitely. Okay, now what does this imply? If we use 10% discount rate and we get positive NPV from the project, it means we are earning more than 10%. Agreed? If we use 10% discount rate and we get positive net present value of 6,000, it means that we are getting more than 10% return. Okay, and in this case, if we have a cost of capital of 10%, we should accept the project because we are getting more than 10%. And if we use 15% discount rate and then PV is negative, it means that we are earning less than 15%. We are earning less than 15%. So if our cost of capital is 15%, we should reject the project. Okay, in the same example, it means we are earning more than 10% but less than 15%. Agreed? Ali, I will share my contact details later on. Don't worry. So it means we are earning more than 10% and less than 15%, right? Okay, forget about the cost of capital at the moment. If I tell you that at 13% rate, the NPV will be 0. If I tell you that at 13%, was there what you didn't understand? Actually, I'm just making a ground. Just listen carefully. You will get the example. So at 13%, if I say that the net present value is 0, now if I tell you that my cost of capital is 11% and the project's NPV will be 0 at 13%, should we accept this project or not? If our cost of capital is 11%, that is what we have to pay to our funds provider is 11%, and at 13% the project will have 0. What does that mean? It means that the project is giving us 13% and we need 11%, therefore we should accept. Abdul Wahab, we should accept this project because 11% is our cost of capital and the project gets 0 NPV at 13%, so it means that we are earning more than 11%. Okay, if I tell you that my cost of capital is 14%, forget about 11%, should we accept this project? Yes, we should reject this project because what we need is 14% and what the project is generating is 13%. So what we have to do is to find out for any project the rate at which its net present value will be 0. So if we are able to find out the rate at which net present value will be 0, we can easily compare that rate with the cost of capital and we will be able to take the decision whether we should accept the project or we should reject the project. Did you get my point? We need to find out the rate at which net present value of the project will be 0 so that we can compare it with our cost of capital, that is the required return. And in that case, we will be able to decide whether we should accept this project or not. Dania, the NPV is not 0 at our cost of capital. We have just tried to calculate a rate at which NPV will be 0. It's not the cost of capital, it's actually the assumed rate. We're just trying to check out at what rate the NPV will be 0 so that we can compare it with the cost of capital. This 13% is not cost of capital, it's just the rate at which net present value will be 0. If we get 0 NPV at a particular rate, it means that this project is generating the same return, because if we deduct this rate, we save nothing. Karai, yes, I have assumed, actually I have assumed the question that at 10% there will be positive NPV and at 15% there will be 8,000. We haven't calculated it, I have just assumed it. So we are trying to find out a rate, we are just trying to find out the rate at which the NPV of the project will be 0. Once we know that at what highest rate of discount the NPV will be 0, we will come to know how much we are earning and should we accept this project or not. So any rate that will give 0 NPV will be called internal rate of return, IRR, a discount rate at which NPV will be 0. This actually tells you a break-even rate. Yes, Reshab, you're right, it's the break-even rate. Shiraz, if the cost of capital is 13% and we get 0 NPV on that, the company will actually be indifferent whether to accept or not. In case we don't have any other better opportunity, the company might go for it because at least it will help us generate the returns that our shareholders are expecting from us. So we might accept, but we'll try. The company will try its level best to get something that will give positive NPV. So all we have to do is to find out the rate at which the project will have a zero NPV, and then we will compare this rate with the cost of capital of the company, and we'll be able to decide whether we should accept this project or not. Let's now look at this example. Things will be further clear to you. Look at this example. Can you people quickly calculate the net present value of this project at 16%? Quick. Can you people calculate the net present value of this question at 16%? I have already provided you with the discount factors, so all you have to do is to just multiply and calculate the net present value at 16%. It's 1803 negative. Okay, let me see. Maybe have a mistake. 9,000 into 0.862. Sorry. My mistake. It's. Yes, thank you for correcting me. It's 7758. It's 23521. 1479 negative. Yes, thank you for correcting me. So we have taken 16% as our discount rate. Remember, this is not our cost of capital, it's just an assumed rate. It's just an assumed rate, and at 16% discount rate, the net present value is negative. Okay. Can you people calculate net present value of this project at 10% cost of capital for me quickly? Just calculate the net present value of the same project at 10% cost of capital. So everyone should calculate so that I'm sure that the answer is correct, because I have to rely on your answers. Okay, 1204. Can somebody else confirm this answer before we can move ahead? Okay, so suppose that the 10% is denoted by A. So at 10%, we have NPV, which is denoted by positive A, is equal to 1204 approximately. Okay, and at the higher rate, which we'll denote by B, is 16%, we have NPV of 1479 negative. So we have one positive NPV, we have one negative NPV, and we can say one thing about this project, that this is generating higher return than 10%, but lower return than 16%, and it is generating a return somewhere in between 10 and 16%. So what is actually the rate at which it is generating? So we need to calculate the IRR of the project, which will tell us the rate at which the NPV will be 0. So what we have to do is, we have a formula for IRR. First we have to place the return A, the rate of return A, that is 10%. Then we have to place the positive NPV in the numerator, 1204. Then we have to take the difference of these two NPVs, that is the positive one and the negative one. So the positive one is 1204. So since we have minus in the formula and minus in the NPV, so the minus sign will just be converted into plus. Then we'll write the positive NPV. After positive NPV, we'll write the negative NPV, 1479. And then we will multiply this figure with the difference of these two rates, that is higher rate and lower rate, 16 minus 10. So remember the BODMAS rule, solve this equation. All you have to do is first take the difference of these two values and the sum of these two. So divide 1204 with the sum of these two values, and then multiply it with the difference of these two, and whatever figure you get, just add it into 10 and tell me what's the answer. It's approximately 12.69%. Okay, thank you very much. 12.69%. The 12.69%, what does this show? This shows that this project is giving you a return of 12.69%. Now, how will this figure help us in deciding whether to accept this project or not? We know that at 12.69%, this project will give you approximately 0 net present value. So make sure you do not accept this project if your cost of capital is higher than this rate, because at this rate it will be 0, and at any rate higher than this, the NPV of the project will be 0. Say for example, if the cost of capital is 14% and if you have already got 0 NPV at 12.69%, definitely at 14% rate it will be negative. So you will never accept a project which will be giving you negative NPV. So the importance and significance of this figure is that it will be compared with the cost of capital of the company. And if we find the cost of capital higher than this rate, we will reject the project, because this project is then going to give us negative net present value. We will only accept project where our cost of capital is lower than this 12.69%. Say for example, this company has a cost of capital of 10%. It means it requires a return of 10%, and the project is already given 12.69%, which is higher than the required return of the company. Therefore, we should accept. But if our cost of capital is more than 12.69%, we will reject the project, since we already know that at 12.69%, the project will have a 0 NPV, and at any higher rate, it will give you negative NPV. So I hope you have understood the concept of IRR. Any comments or any questions? Taha, yes, we should take the low rate first, because we are adding something into that rate. So our IRR cannot exceed our higher rate. The IRR should always be between the lower and higher rate if they are positive and negative NPVs. No, Taha, we should not take the higher rate as A, because if we take the higher rate as A and then add something to it, if you look at the formula, if we write 16% as A and add something in it, the answer will be higher than the higher rate, whereas the answer of IRR should be in between the higher and lower rate. So, 30% which should be used for CBE style. Well, Aisha, in CBE exam, the requirement will clearly mention that you have to round it off or not. So it will be in the question, and if they ask you to round off to 0 decimal place, then you have to write it as 13%, not 12.69%. So they will ask you to round off. Will the examiner would ask calculate IRR or what? Yes, sometimes he will definitely ask you to calculate IRR, or sometimes he will ask you to evaluate the project and decide whether to accept or reject the project based on IRR. So usually it will expressively ask that you need to calculate IRR. Well, Waqas, the difference between the two rates should be as close as possible, but we'll have to make sure that we get one positive NPV and one negative NPV. So we'll make sure that the two NPVs are positive and negative, and the gap should be as close as possible. It will give you the right answer. Yes, we can, Sidra, we can take 18%, but we're not sure that 16 or say 18%. We can take 18%. We can take 18%. We can take 15%. We can take 20%. But our objective is to get one positive NPV and one negative NPV. And second objective will be the gap should be as close as possible. Well, Uzair, you should take any rate as a first rate. Say, for example, you might want to take 12% as your first rate. Just take that 12% rate and check out whether you get a positive NPV or negative NPV. If you get a positive NPV at 12%, definitely you need to increase the rate to get the negative NPV. So the next rate should be higher than the 12%, and should be as high so that you can get a negative NPV. But if you get negative NPV at 12%, definitely you have to reduce the rate to get the positive NPV. So it's up to you which rate you take first. Qasim, yes, 4 to 5% would be great, but it depends on the first NPV. If the first NPV is close to 0, then you don't need to take a big difference. If the first NPV is far from 0, then you need to take a big difference so that it's negative. No, there is no Faiza, there is no defined range for selecting the rates. It's totally up to you. Take the rate that you want, but make sure that you get positive and negative NPV, and the difference is not that big. Thank you very much for all the comments that you people are giving, and I hope that you like it till the end as well. Well, we can take both negative NPVs, but it's advisable not to take. You should take one positive and one negative NPV. And I will share my YouTube channel with you. I have an IRR video in that. It would be great if you watch that video for deriving how IRR formula is being derived. So I have a derivation of the IRR formula on the YouTube. just write my YouTube channel link. Just go to that channel and watch the video for IRR, and it will definitely help you resolve all the questions that you have in your mind. I have derived the IRR formula in that video, so you can see and watch that video. But it's in Urdu. I hope you people understand the language is in Urdu. So I'm just writing it. It's youtube.com/, we'll write it here. It's youtube.com/Ejaz Khan EK. So just go to this channel, and there's a video for IRR derivation. Just watch that video. It will be really helpful for you people. Tomorrow we are going to discuss the payback period and advanced net present value. So on the slides I have mentioned the day 2 plan. So just look at the plan, and you will come to know that what we're going to discuss tomorrow. Good one. Yes, Sundar, so we did not cover payback today. We just ran out of time because of so many questions and getting used to this platform. So probably we'll meet tomorrow's target. Sikandar, for today, all you have to do is to revise what has been taught today. By tomorrow, I will give you home assignments as well, because these were the basic concepts, and we don't have any home assignment for today. Just go and revise the topics, and if possible, try solving few questions from Kaplan or BBP kit of F9. Try solving the MCQs part. Uzair, practice as much as you can. Just take out the past exam papers and try solving all of them. And wherever you feel lacking, just go to the lectures or go to the study text and revise the lectures and get back to the questions. And if you people have any problems, I will also share my Facebook profile with you. Facebook.com/EJJAZ. So you can also join me on Facebook, and if you have any questions, anything that is putting you in problem, you may ask me there. Thank you, Dania. What are the topics that are of most relevance, please? Muhammad Inamullah, this was the question I also answered earlier. All the topics are relevant to you. That's why they are in the syllabus. So try to go through the whole syllabus as much as possible. But since you don't have enough time left for the exams, go for the past papers. Adnan, I have shared my links with you on the screen. It's on the screen, so note it down from there. Kulan, I don't have videos on, but I'm in the process of preparing them, so you'll be getting most of the videos before your exams. Thank you, Faiza. Thank you very much. Sikandar, I will try my level best to cover all the important topics. And even if something is left, I have shared my details with you people. We can discuss anytime after the webinar as well. Well, I will try to arrange MCQs for you people and we'll share these figures with you. But the most relevant MCQs you'll find on the revision kits. Yes, Dania, we'll be discussing almost all the decisions in investment appraisal tomorrow. Fazil, yes, the session is being recorded, and you will have these sessions later on Vimeo as well. It will be shared with you. Sundar, very much. Thank you very much. Which method is better? NPV is better, and we'll be discussing it tomorrow as well. That why we prefer NPV over IRR. Uzair, just review the past papers. Try to review all the past papers for the theoretical section. It will be a best guide in this case. Thank you, everyone. Thank you, everyone, for listening to me so patiently. And I hope that this webinar will be of great help to all of you. And thank you for the kind comments that you've given. And do give me your feedback so that I come up with the most relevant things in the webinar. Well, Sheila, you should start solving the papers from the latest one first, and as many as you can. Definitely we won't go for a detailed ratio analysis, but definitely when we'll be discussing business finance, so we'll discuss the ratios there. Okay, I'll write my WhatsApp number. If you can't find me on Facebook, just text me on WhatsApp. It's without Pakistan code, so anybody outside Pakistan should have 0092 321 2604033. So from within Pakistan, this is what you have to add. And if you are outside Pakistan, you should have 0092 or plus 92 321 2604033. So I'll be available on WhatsApp as well, so you can text me on WhatsApp if you are not able to find me on the Facebook. Shiraz, there is nothing in this session anymore. You may quit. I'm just here to answer a few questions. So you may leave if you don't have any question. Sharoz, yes, definitely. I will recommend questions every day. From tomorrow onwards, there will be home assignments. So you'll be getting all the relevant questions. Thank you, Shiraz. Okay, thank you very much. Thank you very much, everyone. Hope to see you tomorrow. Till then, Allah Hafiz. Bye bye.